Robschild. Nothing I say is investment advice. Welcome to the show where we view financial markets through crystal ball gazing. J.P. Morgan once said, "Millionaires don't need astrologers, but billionaires do." And so we begin. Today is June 4th, 2024. Today we had job openings or JOLTS data come out today. These are job openings. So the last reading of this, 8.4 million expected, flat at 8.4 million, and came out at 8.1 million. I've been talking, if you've been following my show, I've been saying for a while the data is going to keep surprising people to be weaker and weaker. I'm not going to be surprised at all if the unemployment report is above the predicted, the consensus view of 3.9%. I'm thinking 4.2, maybe even higher, but we'll see on that one. Again, if you've been following the show, you'll know that I've been talking about this nonstop. I'm not going to go through the chart again today, but Friday, unemployment, that number, we've been going higher and higher for like a year now, ticking higher and higher, what, 3.9%? Where do we go from here? The only way that I see soft landing or no landing for the immediate future, like is in the next 6 months or year, is if like this really collapses, the unemployment goes straight back down, because once it starts curving up, game over. I'm going to start with the S&P 500 only because it's the S&P 500, probably the most important index to be following, just to get a general broad sense of what's going on. It's becoming less relevant, especially considering how much weight the Magnificent One, now NVIDIA, has on what happens there. But it's still worth using as like a primary gauge for markets. And yeah, we're going completely sideways here. Nothing to see here, folks, really, till Friday. Moving on to some other notable charts. TNX, the 10-year Treasury note yield, cracked through this line. This isn't the first time where we've cracked through this line as I have it drawn here, but it's very, very cracked through this line. And one thing I want to add to this is a few other charts. So the TYX, this is the Treasury yields on the 30-year bond, and so this one is a little more clear. Sometimes it's like the patterns are a little more clear on one chart or another, and it's even more clear on TLT. We'll get to that in a second. But this one right here is the 30-year Treasury yield. As you can see, we directly hit this line several times, and we very clearly, for the first time, broke through it since this started at the end of 2023. Moving on to TLT, if you look, this is the value of those treasury bonds, the inverse of the yields. And so when yields go down, the values of these treasuries go up. Like I've been saying, I am currently, now I'm almost 52% in this, because it's been going up a bit. I added quite a bit of leverage to it like 5 or 6 trading days ago with some call options on TMF, and that did very well today, obviously, in its value. I am expecting this, especially just as the chart pattern, Treasury bonds as a whole, give a very strong indication as to what the risk is, where yields should be. The government doesn't, well, not the government, the Federal Reserve, right now anyway, doesn't control the price of 30-year Treasury bonds. It does when it's, buying massive amounts of them. Right now they're still letting them run off the balance sheet, I believe. But this is largely controlled by the secondary market, and it's the largest market, and so it's like the largest free guaranteed market of return on the global reserve currency, the US dollar. And so once again, I've said this in other shows, this is a hugely important thing to be tracking and looking at. And you know, the market right now finally broke, we've been under this line and refusing to get through it, and just yesterday we broke clearly through it, and today we had major follow through on the value of this fund TLT. This is most traders' favorite vehicle for direct non-leveraged exposure to treasury bonds. And they'll use this primarily for options. Options on TMF, like I'm doing, is a little it's a little extra chaotic, but I can't help it. I really think that yields over the next few months are collapsing, like I've been saying. But again, no investment advice. The one piece here that surprises me is the value of HYT, high yield corporate. If the legs were really coming out of the stock market and people were really fearful here, you wouldn't just see TLT going up as it is. You'd also see the value of higher risk bonds and preferred shares going down, and instead we are going straight sideways. Granted, there's a pretty big battle here, and also granted, this would be dropping in value if it wasn't for TLT going up today. The fact that yields are going down means that HYT should be actually going up. Instead, we are going flat. And so, but again, this is obviously no indication of like running for the hills. This part of the market is very likely, in my opinion, waiting to see what happens Friday with this unemployment data. That's the real kicker. That's the one that's the one that can finally say, okay, guess what, everybody, bad news is here, and bad news is actually bad news, because when everybody's losing their jobs with unemployment, it all rolls on itself. People have less money. They can spend less money. Companies, therefore, can't earn as much money. So then the stocks become more risky, as well as their bonds, as well as corporate debt, corporate bonds. And so those become more risky. And so the prices have to go down. They have to go down in order for anything to make sense. And with people not having jobs, a lot of people are forced into selling assets that they have, which typically are, stocks. And that's why we always have these cycles of overvaluation, and eventually sometimes we have very undervalued securities. And Warren Buffett is very ready for this. As I don't know if you've been paying attention, you probably have heard people talking about how his current positioning is as bearish as it's ever been in his career. He's just loading up on cash right now, and as much as he likes to claim that it doesn't matter what price a security is, that's just a straight out lie. His greatest teacher is Benjamin Graham, and Benjamin Graham says very clearly, very explicitly, the wrong price paid for a security is equal to buying the wrong security. You gotta let that settle in. I've said that a few times on my show, and also in my series on the security analysis book, but that's a huge thing to understand. Anyway, I'm just simply kind of very surprised that HYT is not like showing more fear here. I'm very curious why that is. If I'm thinking, like, if I'm an owner of this fund, and yeah, I'm getting like a 9-10% return, like, really, the signs for slowdown are all over the place, and we're not worried about bankruptcy. I mean, parts of this fund in a downturn will go bankrupt. They'll lose all of their value to get all together, and so the permanent, intrinsic value of HYT over time can and will often drop in value. due to some of its securities becoming worthless. I often talk about HYT being kind of, you know, the most risky smart money, I guess you could call it, and so it's very important to follow. And I just I don't get it. I mean, maybe this is like the kind of thing that maybe what's holding it up is, I mean, look, high yield corporate is less risky than stocks, right? So a stock, you're never guaranteed earnings, you're never guaranteed payments from a stock, but you are guaranteed from high yield corporate bonds. There are bonds that say yes, they have to pay no matter what, even if it means selling everything they own, if it means selling the factory, the equipment, the resources, the patents, everything that they have, the real estate, everything that they have to sell in order to pay off the bondholders. That's how bonds work. And so, you know, maybe this is representing, maybe smart money is actually selling stocks here and actually going into high yield corporate. Just, you know, when you think about risk and reward, it's still a good deal to have, you know, a bunch of people owe you a, you know, 9 to 10% guaranteed return, you know, from corporations. And you know, but again, I don't know what's going on here, other than holders of these securities are not sniffing out major risk yet. I think they will. I think it's coming. And then when this starts really cracking and showing, you know, bumping its head on the way down, that's when we know we're in a true bearish situation. And I do expect that to start soon. I've been meaning to share this chart for a while. I almost shared it, but then it got messed up in my video processing. Won't go into detail, but yeah, I didn't actually include it in the video I intended to have it in. It was on this day. It was on last Friday. I meant to add this in here, and I kept forgetting to add it. But anyway, we clearly have a double top in silver here. And so I was saying, well, what I wanted to say on Friday, what I was thinking was, if we break this bottom of this M pattern here, that you know, that means bearishness for silver. So, and today we broke below the bottom of this double top pattern, which means to me that it's very, very likely silver is about to go down again. From a historical basis, you know, silver is not even near a cheap range until it's below $20 an ounce. And so if we get below $20 an ounce, I might be participating in allocating some capital into this market. My favorite way to get exposure to this is SILJ, the juniors, even though, you know, I hate junior miners in general because so many of them don't actually produce anything and will never make a profit, but they automatically get like a lot of leverage to go up in value if its underlying commodity goes up. And so it's the easiest, safest way, the way that I see it, to get the most reward for the amount of risk that you're taking in a commodity market like silver, Bitcoin, or gold. Well, I guess there's no junior Bitcoin miners, but you know what I mean. So one more chart to show is just the fear and greed index. We finally you know, I said this whole week I was expecting us to be wavering around 50, it acting as sort of a magnet. I am surprised to see this dropping into fear today. The VIX did not like go spike up majorly. This uses other momentum indicators, you know, what's going on with the pricing of lots of stocks, and It smelled a lot of fear today. We went from yesterday at 51 all the way down to 42. So that's a very fast and large drop in their fear and greed index. And to me, that's, again, I think it's sniffing out. It's a little worry. People are worrying correctly so that unemployment could be going up again with the JOLTS data that came out today. The job openings being significantly lower than expected. There's less jobs available. Unemployment has been going up. I mean, it doesn't take a crystal ball to entertain the idea that this might be starting, this recession or depression. And that's all I have for you for today. Hope you enjoyed, and thank you for watching Robschild.